Regardless of the economic climate, one way that stock market investors can produce some income for their portfolio is by investing in dividend distributing companies that have a proven track record of continuously paying out their dividend and raising those dividend payments over time, which is known as a dividend aristocrat. Hey, what's going on, savers and investors? As always, I hope you're having a great day. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be speaking about a highly relevant topic considering the current market condition and overall just uncertainty and somewhat fear that can arise right now in the stock market. This topic happens to be dividend stocks, which is always a favorite on the channel, but not just any dividend stocks. Today we're going to be looking at companies that have a proven track record of consistently paying out and raising those dividend payments for a minimum of 25 consecutive years, which puts them in a category known as dividend aristocrats, which can be somewhat sought after investments to include in your portfolio during a period of market downturns such as what we're experiencing right now. I've made a couple videos speaking about dividend aristocrats in the past on my channel, so you may or may not already be aware of what these are, but essentially these are companies that have been consistently paying out and raising those dividend payments for a minimum of 25 consecutive years in the United States and then 5 years only in Canada, just based on the fact that there are far less securities listed on the Toronto Stock Exchange. With that said though, in today's video, we're going to be focusing on 8 dividend aristocrats from both the Canadian and the American market, probably about 4 from each, and we're going to be focusing on companies that have been paying out those dividends for minimum 25 years, but oftentimes have far exceeded that 25-year threshold. And also we're going to be focusing on companies that have a relatively feasible dividend payout ratio in the coming year. If you're not super familiar with what dividends and dividend aristocrats are, then that's totally fine and is ultimately the reason why I make these videos, so that you guys can learn the basics of stock market investing. So let's take a little moment here to speak about these two topics and get you up to speed with what we're speaking about. But if you are already well aware of what these two topics are and how they have an impact on the long-term growth of your portfolio, then feel free to skip to the area I'm highlighting right here on the video, where we dive directly into the stock picks. Starting with what dividends even are, quite simply, dividends are a distribution of earnings, typically in the form of cash to shareholders of a company simply for holding the stock. Dividend distributions are typically paid out on a quarterly basis, but some companies choose to pay them out on a monthly, biannually, or even on an annual basis. It's pretty much the choice of the company. If a company's share price is trading at $10 per share and this company is paying out a dividend of 10 cents on a quarterly basis, well, this means that in one single calendar year, this company is paying out 40 cents worth of a dividend, and at a share price of $10 per share, this means that this company has a 4% dividend yield. Now, typically we have what are known as growth stocks as well as dividend stocks, with growth stocks being companies that are fully utilizing their earnings in order to reinvest into the company and continue growing the company's operations. And with this, usually growth stocks are going to have a much quicker growth rate than dividend stocks, which on the flip side, dividend stocks, especially if they're dividend aristocrats, are usually going to be companies that are well-established blue chip stocks with recurring earnings that are somewhat consistent, and for this reason they're able to pay out a consistent dividend over a long period of time. Oftentimes, dividend stocks can be considered by investors to be a safer investment relative to growth stocks, and for this reason dividend stocks are usually going to provide your portfolio with steady income as well as appreciation over time. Now, this is not to say that this is a golden rule that all dividend stocks are going to be a safer investment than growth stocks. Not at all. Every single company needs to be assessed properly before taking a position in that company and adding it to your portfolio. But when you invest in a company that pays out dividends and you as an investor take those dividend payments and then just reinvest them back into your portfolio, whether it's into that company or another company, this can have a profound effect on long-term compounding of the value of your portfolio. Now, why am I saying that this is a highly relevant topic, especially amongst this current financial climate? Well, there's actually several reasons to this statement, starting with the fact that dividend aristocrats, for the most part, have somewhat created an expectation in the eyes of investors that regardless of the economic climate and the short-term share price, they're going to continue paying out those dividends, meaning that investors can have recurring income in their portfolio regardless of the economic climate. Now, obviously, this is not set in stone, and not at all. A company can choose to cut their dividend payment at any point in time if they so choose, but it's not necessarily in a company's best interest to do so unless they really have to from a financial standpoint, because for many investors, especially if they're looking to invest in a company that's been paying out those dividends for 25 years consecutively, this is an extremely attractive element that can be a factor that's making them invest in this company. And this actually brings me into my third point, which is that currently you can lock in some higher than average dividend yields on cost because the share prices are typically going to be much lower than what they were trading at only a couple months back. So quite simply, if you're purchasing a share for say $10 right now and the dividend distribution is 40 cents on an annual basis, well, that dividend yield is 4%. If you had purchased that same share for say $20 only 2 months back, but the dividend distribution is still the same in terms of cash value, that would mean that the dividend yield is only 2% back then, meaning that right now with the current prices, you can lock in some higher dividend yields on cost, which is going to have a long-term effect on your portfolio. With all that covered, before we dive into some great recession-proof long-term Dividend Aristocrat stock picks, I want to mention that if you want to keep a full tabs on your personal finances, including your net worth over time, income, expenses, your stock market portfolio, and automating your dividend income tracking, then I've created over the past month the mother of all personal finance spreadsheets just for you. This spreadsheet has 6 tabs that are all interconnected, feeding back into the main dashboard to keep track of your net worth over time, and is filled with visually appealing graphics to help you better grasp your financial data. One of the best things I've integrated into this sheet is automatic dividend distributions by connecting to an external API. So for all American securities, this will all be pulled automatically into the sheet based on the tickers of your holdings. The stock transaction tab is also filled with extensive formulas to accurately calculate your exact adjusted cost basis from dollar cost averaging based on buys and sells of your position, and gives you the accurate return based on all the purchase prices combined for that one security. If you're interested in receiving more information about the sheet or picking up a copy, then make sure to check out the link down in the description, which will bring you directly to it. All right, so with all that said, let's now dive into those Dividend Aristocrat stock picks that one could want to add to their portfolio for long-term recession-proof dividend investing, starting with the Canadian positions, and then we're going to move on into the American positions. And if at any point in today's video you're enjoying the content, then make sure to smash the like button. So on that note, let's get into these stock picks. The first company we're going to be looking at is a staple Canadian Dividend Aristocrat that I've spoken about on the channel before due to its great earnings and business operations in the utility sector. It is Fortis Incorporated, also known under the ticker FTS on both the Toronto Stock Exchange and also the New York Stock Exchange. And this is one of Canada's longest paying dividend aristocrats at 47 consecutive years. So this company has been paying out those dividends through the 1987 crash, the dot-com bubble, the Great Recession, and hopefully, most likely, the current 2020 crash. Fortis owns and operates utility, transmission, and distribution assets in both Canada and the United States mainly, serving electricity and gas to more than 2.5 million customers. And think of it this way, as everyone is cooped up in isolation right now, we're still consuming quite a bit of electricity. Obviously, we still don't have a Q1 earnings yet, but over the past 5 years, Fortis has seen nice increases in both revenue and net income, and currently with the price of this stock down roughly 22% after yesterday's nice trading day, I personally believe this is a steal of a price, and I've purchased quite a few more shares of the company because I see this as a great long-term hold. Dividend yield on cost is also reflective of the lower price point at 4.16% at the time of filming the video, which is a great dividend yield for a company such as this one with a dividend payout ratio of 48%. Moving on now to the second Dividend Aristocrat stock on today's list, we have a company that operates in the industrial sector, and you may not have heard of this company before. It is Toro Industries Ltd, ticker TIH on the Toronto Stock Exchange, and this company has been paying out their dividend for 31 consecutive years, which for a Canadian company is actually among the highest. I hadn't mentioned this company in previous dividend stock picks because the yield was pretty low at around 1.5% only a couple months back, but right now with the stock dropping to around $60 a share, the yield is currently about 2.2% at a dividend payout ratio of only 30.95%. If you aren't sure what this company actually does, it operates two main business segments known as Equipment Group and Kimco, with the largest portion of revenues being derived from Equipment Group. That includes a Caterpillar dealership, so CAT, with their heavy equipment, and then also rental operations of construction equipment. Over the past 5 years, this company has seen significant increases in both revenues and net income, leading to an increasing stock price, topping up at roughly $72 a share. And right now you can pick up shares for around $60.75. This company really hasn't seen a huge decline in share value relative to other companies, and that is largely due to the company's business operations. Next up on the list for Canadian positions, we have once again a company I've spoken about in a previous video, and the specific reason I had mentioned it was due to the recession-proof business model it has, operating in the consumer defensive category, and it is Metro Incorporated, ticker MRU, on the Toronto Stock Exchange. And let's just take a quick look at the chart for this stock. As you can see, it is pretty much entirely unaffected by what's going on right now in the markets, and this is completely understandable based on their business operations, owning hundreds of grocery stores and pharmacies across the nation. And in fact, grocery stores are among the only businesses that are actually allowed to even be open in Canada right now, so I wouldn't be surprised if earnings are completely unaffected in Q1 and Q2. MRU has been a Dividend Aristocrat now for 26 years, and although the yield of 1.58% isn't necessarily the highest or most attractive yield, I'm mentioning it because this is nonetheless a great position to hold as a consumer defensive stock, which can weather extremely well, as we're seeing right now, through recessions and market downturns. The company's financials are extremely solid and consistent, as we can see here with the revenue and net income numbers reflective of this company's business operations. And finally, MRU has a dividend payout ratio of 30.08%. And overall, this is just a great consumer defensive position to hold for long-term gains. The fourth Canadian position we'll be diving into today is a popular Canadian Dividend Aristocrat of 25 years, and it is the Canadian National Railway Company, ticker symbol CNR on the TSE, which currently is trading for around $106 per share, down roughly 15% since February. And throughout this whole market downturn, the stock has honestly weathered quite well in comparison to other sectors, and that is most likely due to the nature of this company's operations, which are the transportation of various goods such as intermodal containers, petroleum and chemicals, grain and fertilizers, forest products, metal, automotive shipments, and more on their network of railways spanning all across Canada, and then also from Chicago to the Gulf of Mexico. So a pretty extensive set of rail lines, to say the least. This is the type of company that even during a period such as what we're experiencing right now, transportation of goods and materials is a critical aspect of many other businesses' operations, which would rely on Canadian National Railroad. The company also has a relatively lower dividend yield at 2.17% and a dividend payout ratio of 36.88%, which is nice to see for a Dividend Aristocrat. And if we take a look at the financials here, this is somewhat what we would expect from an established company with steady but growing revenues as well as net income. And also, this is a company that has an astounding amount of assets on their balance sheet at $43.7 billion as of 2019. Now that we've had a chance to take a look at some great Canadian stock picks, let's take a quick trip south of the border in order to go over some great American recession-proof dividend stock picks. The first American company we'll be speaking about today is one that I can pretty much guarantee you've purchased their products before, because they have their foot in so many household brands that are consumed pretty much on a daily basis. It is the company Procter & Gamble, trading under the ticker PG on the New York Stock Exchange, and this company is a Dividend Aristocrat of 63 years, which is pretty impressive if you actually think of of what this means. 63 years of raising and paying out dividends regardless of the economic climate. Some of P&G's most well-known brands include Tide, Pringles, Gillette, Olay, Oral-B, Head & Shoulders, and the list really goes on here, kind of like what I would mention with Metro Inc. These are products that people are consuming regardless of the economic climate. People don't necessarily need a Bowflex during a recession, but shampoo and razor blades are always a must, making this a highly consumer defensive company. The stock currently trades for roughly $100 per share, down around 20% since February, which is more than what I would have expected, but nonetheless, this is a great long-term position with a current dividend yield of 2.96% right now and a dividend payout ratio of 65.93%. Bottom line, Procter & Gamble is a recession-proof stock simply due to the nature of their products and will continue being a good defensive holding for years to come, especially with that 63-year dividend growth streak. Next up on the list is another consumer defensive stock that is relatively similar to P&G in regards to the fact that a number of their products and brands are household staples that we all have consumed at one point or another, and that is Johnson & Johnson, founded in 1886 and which is now a Dividend Aristocrat for 56 years of consecutive dividend growth. Johnson & Johnson trades under the ticker JNJ on the New York Stock Exchange for currently around $120 per share, down roughly 23% since early February. And this is once again a consumer defensive company. Regardless of the economy, their products are going to be purchased because they are everyday use products such as Benadryl, Band-Aid, Reactin, Neutrogena, Listerine, Tylenol, and many more. The company's financials, once again, are typical of such a giant corporation with massive revenues growing year over year, and currently the stock has a dividend yield of 3.18% at a dividend payout ratio of 43.78%. If you're looking for a solid Dividend Aristocrat with a nice yield and current discounted price, make sure you take a look at Johnson & Johnson for a nice long-term hold and dividend income. Moving on now to the third American Dividend Aristocrat, which is a good choice regardless of economic climate. This is a company we mentioned in the last dividend stock pick video, but highly relevant for this video, also for its 47-year dividend growth streak, and it is PepsiCo, ticker PEP on the NASDAQ, which is currently trading in the waters of $112 per share, down roughly 21.5% from $147 per share in mid-February. And the reason why I'm mentioning this stock once again today is primarily due to their product offerings and subsidiary companies. Pepsi has their foot in multiple different beverages and food areas, owning Frito-Lay, Gatorade, Quaker Oats, Tropicana, Brisk, and multiple more household staple brands. So for this reason, regardless of what we're going through economically, these are brands that people are just going to continue buying and consuming from. So in my opinion, a 20% discount on this stock, considering that it's a company that is going to be thriving in 5 to 10 years from now and rarely sees discounts of this nature, this is a great position to load up on right now. And on top of everything mentioned for Pepsi, the price right now is translating into a nice 3.3% dividend yield on cost right now. And finally, the last position we'll be speaking about today is another consumer staples giant whose brands are most likely in your cupboard as we speak. It is the Colgate-Palmolive company, also known under the ticker symbol CL on the New York Stock Exchange, and this company has a dividend growth streak of 56 consecutive years. Their most popular brand names are, as the name would suggest, Colgate and Palmolive, but they're also the owners of many more brand names such as Huggies, diapers, Kleenex, Irish Spring, Speed Stick, Scott Towels, Soft Soap, and even the veterinarian animal food company Hill's Nutrition. So with this company, you're looking at a pretty well diversified line of products in many different areas of your household, and you could now pick up this stock for around $60 per share, down about 22% since early February, which isn't too bad, and the dividend yield is quite nice right now for a company such as this one at 2.94%. So once again, as a somewhat recession-proof dividend aristocrat, Colgate-Palmolive is a great stock to pick up at a discount right now. All right, so that pretty well wraps up the Dividend Aristocrat stock picks that I wanted to cover in today's video. If at any point in time you enjoyed the content and it provided you value, then make sure to give this video a thumbs up and also consider subscribing to the channel if you want to learn more about personal finances, investing in the stock market, and a bunch of other financial topics. And also, if you want to learn more about investing in the stock market, then make sure to check out one of the two videos right here. So on that note, thanks a lot for watching, and I'll see you in the next video.